Good morning, everybody. Hopefully, you had a wonderful weekend. We got a special guest today, Andrew, who is a life insurance specialist from ECA with a great concept. Guys, this concept could increase your bottom line from anywhere from 10% to 50% in the upcoming year. So please pay attention to what we're saying and then think in your head, who do I know that this would pertain to? So obviously this is what he's going to go through some concepts that are very particular to certain people, but when you know that person, they're going to be enamored with this concept. So I want to thank Andrew for being on today and sharing it with us. So I'm going to turn it over to you, Andrew.
Excellent. Thanks, Mike. Good morning, everyone. Like Mike said, I am the life insurance marketer over at ECA. I know I work with some of you. Others of you may work with Shane, Seth, so on and so forth. Everyone is very up to speed in the concept that we'll be going through. But first things first, I just wanted to run through the opportunity that comes up just with cash value life insurance using IUL, right? The design that we put together and then how we can take that standard max funded IUL design and make it better, put them in a better position rather than going through, say, a standard premium finance or your traditional premium finance where you have to have the individuals that are $5 to $10 million net worth. With interest rates that are continuing to go up. I know that our standard premium finance business has come not quite to a halt, but it has definitely slowed down with interest rates going where they're at. So just to start this off, as an example, this is a 40-year-old male, preferred plus non-tobacco. Again, if they have assets, income, something that we can find to reposition over into, this is an Allianz Life Pro Plus Advantage. What we're illustrating here is going to be $50,000 a year for 7 years. And let me make this a little bit bigger just so that everybody can see it. And then if there are any questions, comments, anything like that, put them in the chat box. Mike and Missy will send them over to me. I just want to make sure that we're addressing everything as we go. So, like I said, 40-year-old male, preferred plus non-tobacco, is going to put in $50,000 a year. We have it illustrating for 7 years. How we have it built is going to be for the minimum death benefit to allow for the maximum accumulation, and we are going to increase that death benefit while we fund this policy. This allows us to get as much cash value built up in this policy as possible compared to, say, a level death benefit where you're going to be paying for more insurance. It's going to be the level death benefit all the way throughout, and the accumulation isn't going to be as strong. After we're finished funding in the 8th year, we drop that death benefit. So again, we're not paying for unnecessary insurance while this policy continues to accumulate. So again, on this design, paying into it 7 years, and then we let it cook. Illustrating income. Retirement income again here starting at age 65. I'll continue on to the next screen so that you guys can see. Projected rate of return on this is going to be 7%, that being because of the 165% participation uncapped with Allianz on both the PIMCO and the Bloomberg. So that's where we're getting the projected 116 and change for retirement income all the way through age 95. So this is a great opportunity, right? This is something that they can use to build tax-free income for retirement rather than being fully taxable if they're going to put it into an IRA, 401k, something in that regard. So this is a great opportunity. So now if we can take this and we can make this now better, put them in a better situation, we feel that is this worth having a conversation. How we're going to do that is we are going to play in on the variable loans of the policy. That meaning when we take a loan on this policy, it is going to stay in the account value and it is going to receive that index credit every single year. So what we're going to do is we are going to take this asset, being cash value life insurance, and in the 4th year, we are going to start to leverage this policy. So what we're going to do, and again, this is where this varies from standard premium finance, and I will get into another example through Kaizen if we have some time, as long as there's not a bunch of questions that we got to run through. But in the 4th year, we have the option that we can start taking a policy loan. We just illustrated $25,000 But it can be more, can be less. It is flexible, dependent upon how the policy performs, how the client is feeling about things at that time. Again, do we leverage it? Do we not? We have the flexibility to do this each and every year. But for illustration's sake, we start off illustrating taking a loan of 25 grand, and we're going to do that starting from year 4 all the way through year 7. And we're going to take that 25 grand and put it back into the policy as new premium. So now, rather than just the 50 grand for 7 years that we originally illustrated, they're going to see 75 grand years 4 through 7 that we're leveraging on the policy. And then starting in year 8 through 15, we are going to take the full 75 grand as a policy loan and put back in as new premium. Okay, so why ultimately are we doing this, and why do we like it, say, with an Allianz, with an F&G, LSW has an aspect to it as well, because that variable loan has a contractually guaranteed 5% on that loan rate. So that, especially right now with where interest rates are at, where they're headed, we feel that that is a very powerful conversation to be having, with your higher net worth individuals, that if you can guarantee their loan rates at 5% right now, and they're not at the mercy of outside interest rates going up, going down, so on and so forth, it adds a level of predictability to the asset that we can start to leverage. So again, why we're taking the loan, putting it in, and leveraging it, the play there is playing in on the arbitrage. So that meaning if policy can perform more than what your loan rate is, you now just made money on a loan that you put back into your policy. So guaranteed 5%. If your policy can earn 6%, you just made 1% on that loan money that went back into your policy that you're in essence doubling up on now. On the illustration, we can only, just because of AG 49A, we can only illustrate 50 basis points of arbitrage. So what is a point? What is a point and a half going to do? So we went from that projected 116 and change of income at age 65, and now we have taken that and bolstered that up again because of the arbitrage opportunity and making money on that loan money. We have now increased that income opportunity to a projected income of 153 and change. And again, that's all the way to age 95. And that's only illustrating 50 basis points on that variable loan. So ultimately, what could a point do? What could a point and a half do? How is that ultimately going to increase that projected income opportunity? So that, again, is taking an asset, being cash value life insurance, tax-free, leveraging it, continuing to build that up, and increase that income opportunity. So now, again, how can we take this and how can we make it a little bit easier to work with, a little bit easier to understand, rather than, again, taking as you can see, 52-page or 51-page illustration and sell off the illustration, right? That's just not going to work from a sales process standpoint. So what we can do is we can partner this with a software that is called Insight that actually backs in to Allianz's illustrating software. So we can take this and we can plug it in into this illustration software. But before I get through or get into the software, the presentation, anything like that, Mike, Missy, was there any questions as far as the design itself, how we're leveraging, anything like that?
Well, let's see here. There's a question. Is this a cash balance program? Oh, never mind. Yeah. I think those, John, go ahead and get a hold of Andrew afterwards. Those are very particular or very in-depth questions. So, and then, right. Okay, so yep, that's good. No, we're good to go.
We're good? Okay.
Yep.
So then again, so we can take that, and then rather than using any kind of other, softwares or storylines or anything like that, we can take Insight, and Insight actually backs into I want to make sure that we can see everything here, into the carrier compliant illustration. So again, this is going to be an opportunity that rather than taking that illustration, the 52-page illustration, you can now, when we send this to you, it'll be a hyperlink that the presentation will come out something similar to this. So rather than going through the illustration, you can talk with them, have that conversation on, okay, if we're going to take that 50 grand a year for 7 years, we're going to put it into this policy, right? It's going to continue to accumulate. At age 65, it is going to kick off that projected 116 and change, okay? So then you can use this as an interactive opportunity that, hey, if you live a long, healthy life at age 95, you've now taken your 50 grand a year for 7 years, and you have now pulled 3.6 million of tax-free income off of this policy. And then on top of that, your beneficiaries are going to still get $628,000 of tax-free death benefit that will be passed to them after you have pulled that $3.6 million death benefit. See, that's great numbers. But again, if we can take this and we can make this better for you, is that something worth having that conversation on, right? So again, same 50 grand out of pocket for 7 years. Now projecting this is going to be with that leverage that we talked about here, right? So this is with that 25 and 75 grand on that variable loan rate. If we can take this policy, use your policy as an asset and leverage that money, put you in a better position as long as the policy performs, what is that ultimately going to do for you? Again, at the age 95, you live a long, healthy life. You have now went from pulling $3.6 million tax-free off of this policy all the way up to, call it $5.5 million in tax-free income, and your beneficiaries are still going to get $1.3 million in tax-free death benefit after you had pulled your income off of this. So the nice thing, this would be the presentation that you would be sent out from your life marketer, again, if you wanted to have the conversation on a leveraged IUL. And the other thing is that you can have the conversation on, how many times have you ran into, oh, the life insurance is expensive, oh, the IUL is expensive, there's so many charges, it's going to draw down. Well, this, again, from an interactive standpoint, you can have this conversation with them and show where the charges are at and how the policy is ultimately built, right? The IUL is built to have charges highest in the early years, least in the later years when you need it most, rather than, say, a whole life policy that is going to be divided up, broken up evenly throughout life expectancy. So again, higher in the earlier years, a lot less in the later years when you start pulling that income and when you need that policy most. So again, this is just a way to put it in front of them, have this conversation with how the policy is built if the conversation of charges ends up coming up. And I know that there was a few other options, few other tables that you can manipulate or throw in if you wanted to get very in-depth with the presentation and have it be more of a full-blown retirement income conversation. You can go through and you can have this conversation with your life marketer here at ECA, and they can plug in all their different, whether it be income, Social Security, retirement assets, growth options, all of that, and then how the life insurance is going to help supplement that income or not. So again, this is just a very robust opportunity from a presentation, interactive standpoint, rather than taking that 52-page illustration and trying to have the conversation there. So that is what we can do from the standpoint of, again, taking this, putting it into the software and having a presentation for you rather than the illustration. Like I was saying before, this is with Allianz. We do like Allianz just because of the guaranteed 5% loan rate on that variable loan. But this isn't specific just to Allianz, right, if you guys like, say, LSW, if we can get over $1 million in death benefit on LSW, we could look at the Summit Life product. That's a very good accumulation product if we're over $1 million. F&G, if you like the Barclays or a higher, just a standard S&P cap, they're sitting at 12.5 on their S&P cap. So the conversation is just showing them ultimately how to take an asset, cash value life insurance, leverage that asset, and potentially put them in a better position on a tax-free income opportunity. So from there, Mike, Missy, any questions on the Insight software?
I think I know the answer to this, but we have a question. Do you have any software that can compare a whole life to the IUL? And I guess probably not, because that would depend on the IUL. I'm sorry, on the whole life. On the whole life,
yeah.
Yeah,
so we don't, I would have to see if the Insight, if we have one, and where I was saying that we could change different carriers is that through our parent company, NFP, we do have the Insight software that we can plug in on the core carriers. So Pac Life, LSW, John Hancock, Lincoln, they're all on there. I know that there is a whole life option, so I would have to go in and see if like a Mass Mutual is in there that we could throw in on there. So if you could, okay. Mike, who asked that question? I could get back with them.
Nick did. So Nick, can you reach out to Andrew afterwards, and then he can kind of give you particulars on that? Yeah, he said he will.
Okay, awesome. Yeah, because like I said, we have this presentation software through our parent company. It's not as robust as the one that comes through Allianz. So the one that you would see that would come through NFP if we changed carriers, it would basically be this presentation just of the product itself, and then there could be a charts and charges option. So there isn't the retirement tax efficiency or anything like that. Allianz does include a sales story, if you would. And again, this is something that you could go through with them prior, because we can take this and we can move this up and again, manipulate this accordingly, however you guys see fit. But it's just a piece that you can go through, have a conversation on why we use cash value life insurance. How does IUL work? Where does it fit? How does it perform? How to use the loans, and all of that. So it's just, again, a easier to look at conversation piece that you can then get into the conversation on taking this policy and leveraging this policy.
Perfect.
So is there any other questions in there before I jump over to Kaizen? I guess we have more time than I thought we were going to. I thought there would be a few more questions, but I can jump over to Kaizen. Are we good?
Yep.
Any questions, guys? Now's the time to ask. If we, or again, you can reach out to your life rep or Andrew afterwards. So,
good,
guys. First of all, before we go though, I want everybody's opinion on this. How powerful is this? So I've never seen this software. How powerful is this software? And do you like it? And would clients like to see this? I mean, does it make a good case? Oh, while we're waiting for that, the guaranteed loan rate of 5% is the max loan rate. Is that correct?
Yep.
Okay. Everybody's saying they like the software. So okay.
Awesome. All right. So what I'm going to do is, I'm going to take and I'm going to switch gears, and where this ultimately comes into a comparison conversation that we like to have. And for those of you that are familiar with this strategy, again, this is a great story. Let me get up to this and I'll zoom out a little bit. And so this is, if we were to get into the conversation of more a premium finance using an external lending source rather than using that policy, right? So and I'll go through the strategy itself, and then I'll go and compare and contrast why you would go one over the other. Obviously, especially with interest rates where they're at right now, that conversation on leveraging your own policy might be a little bit more powerful than going, say, with an external lending source. And here's the reason why. So Kaizen is it's a lower level premium finance opportunity for those that are higher income earners, 120,000 plus, or there's a smaller net worth, say $1 to $2 million in net worth requirement, compared to a standard premium finance, like with a Succession Capital, Julian Malvasian, where we need a $5 to $10 million minimum net worth. So Kaizen is going to cast a larger net for your higher net worth, but not ultra high net worth individuals. And what the opportunity is they are going to pay, it's going to be a lesser premium outlay than a standard premium finance. They are going to pay out of pocket for 5 years. So as you can see here, on the caption, they're going to pay out of pocket for 5 years. The bank, what they're going to do is they take and they accumulate, because they're smaller policies, they're going to accumulate a large number of these policies and put them in a pool together, in essence, that they call a tranche. They're going to take that money, they're going to lock down that loan money that they need to then take and fund that client's policy along with them. So first 5 years, they're paying out of pocket the premium. Bank is going to match that premium first 5 years. And then in years 6 through 10, the bank is going to pick up that money and they're going to leverage that bank money. So it's a very similar conversation that we just got done with talking on the Allianz product on leveraging it in those later years after we're done funding. So again, this is especially when interest rates were really, really low, call it a year or two ago, this was a great conversation to have with clients that, hey, you're going to pay half the premium, bank is going to match it, and then bank is going to pick up and fund the full policy years 6 through 10. So now I'll get into premium outlay and income opportunity. So big things here to note compared to the leveraged option that we went through with Allianz. So as you can see here, premium outlay, they're going to go 44.5 out of pocket for 5 years. Bank is going to match that. Same, they're going to go 45, and then they're going to pick up that full 88 years 6 through 10. All right. So now you're using bank money to leverage this policy and accumulate more. The big difference is between the two is that in this leveraged option that we were talking about, in here, we have the opportunity to leverage or not leverage. Okay. So starting, say, in year 5, you don't want a policy doesn't perform, you don't have to take this policy loan. They just pay out of pocket the 50 grand rather than 75. Or in year 9, again, if policy is not performing, you don't have to leverage this policy on the annual basis, or if it performs very well, we can leverage it more. So just because we have the flexibility. And the nice thing is that in this 15-year time frame that we are funding and leveraging this policy, client has access to this policy at any time. So if they have an emergency, if they need to take a loan off of their policy, this is still their asset. They're still in control of this. So at any time, they can take a loan against this cash value, say they need to buy a car and they're going to pay that loan back. They can take out, buy a car if they have medical expenses, whatever it may be, right? They have full accessibility to this policy because we don't have any outstanding loans from a bank. That's the big difference here, is that as you can see, we are going to pay that loan back on Kaizen in year 15. So the first 15 years, this policy is going to be very rigid. We do not have access to this policy. We are locked into the loaning and the leveraging with the bank money on this policy. And you're at the mercy of interest rates, outside interest rates, right? You don't have that contractual guarantee 5%. So you're at the mercy of interest rates in the bank loan, and you cannot touch this money until it's paid back, and you pay that money back there. But again, still kicks off a nice projected, call it 122,000 of income. I know we're showing a little bit less in premium out of pocket, but ultimately you guys get the concept in comparison. So again, big difference between the two is flexibility, right? Very rigid in the beginning years, bank is going to throw more money in comparison. But again, if policy performs on that Allianz, we could leverage that a little bit more. But again, no accessibility in beginning years until that bank loan is paid off. Then you can turn on the income at any time thereafter. You are at the mercy of that outside interest rate, whether they go up, they go down. It is not a contractually guaranteed rate like it is on the Allianz in comparison. So that's going to be, again, the biggest difference when interest rates were very low. This was a great conversation. This was a great story when we were only illustrating bank loans at, say, 2.5% or 3% compared to 5.5%. And I know actually these rates have gone up a little bit since I've pulled this example. But again, just wanted to give you guys a comparison on how we, if you get into that conversation on why wouldn't we do premium finance compared to a standard leveraged out-of-pocket option. So from that standpoint, is there any questions? And again, I'm not saying that Kaizen is a bad strategy. It's actually a great strategy. We do a good amount of business. It's a great story. Again, matching that bank money, matching your money. But again, just comparing side by side why you might do one versus the other in comparison. So from that standpoint, Mike, Missy, any questions?
You must be doing a great job because no questions.
I was just going to say, Bob, are you able to actually see the chart that he's got on the screen? It looked like you were asking for it to be recentered, but it's pretty centered now. So just want to make sure that you could see it.
Okay, so everyone can see it now.
I think we're good. I haven't seen anything else pop up here. So.
Okay.
Okay. Yep. I got a confirmation that yes, they can.
Okay. Awesome. So again, biggest difference, and I will actually pull the guidelines for Kaizen. I believe it's like 150 in income plus $1 million net worth, or $2 million net worth and 100,000 income. I'll pull the difference between the two. Have to go through, get approved for the bank loan, all that good stuff. Again, another big difference on why you don't have to go through all that. Kaizen, you don't have to post collateral because they'll post that policy as it. But if you get into the conversation of a standard premium finance, where a lot of those deals start to hit roadblocks is when you get into the conversation of posting collateral, right? So if you have a $5 to $10 million net worth individual that you're doing a standard premium finance case on, they might be asking for $500,000 to $1 million in collateral. It's one thing to talk about it and have that conversation with somebody. It's a whole nother thing to go through that process and actually post that asset as collateral and lock that asset up. So that is, from the premium finance cases that I've done, has been a hurdle that we have to obviously continue to get over. But if you're just using your policy itself, you don't have to post collateral. You don't have to go through, get bank approval. You don't have to jump through all of those hoops. It is just going to be based off of the financial underwriting on the death benefit that we are applying for, as long as we, again, have financial justification based on their net worth for the death benefit that we're applying for. Premium minimums. Go ahead.
Go ahead. Okay, go ahead.
Premium minimum. Yeah, premium minimums on this one to where we'll start to see the benefit is going to be anywhere that $20,000 to $25,000 a year, to where we can start leverage it. Anything under that, there just isn't enough cash value to where you're going to see substantial enough growth on from a leverage standpoint. So, and it could be anywhere from anyone mid 20s, 30s, all the way up to mid 60s, mid to late 60s is kind of the cutoff. Once we get into 70s, the cost of insurance starts to work against us and the leveraging isn't as attractive, just because, again, the cost is a little bit more than what is needed, and it's not as attractive from that standpoint.
So, especially with the Allianz at this point, just because it seems like a little bit better, give me an example or two of clients that if somebody looked into their book of business and say, wow, that's somebody I should approach with this. So obviously you've
Sure.
given the minimum, things like that, but what kind of people buy these or invest in these?
Yes. Yep. So for the younger, so call it anywhere from from your 30s to call it 50s. Typically, those are going to be clients, high income earners that we can reposition income. They might not have the assets built up yet that we can reposition from that standpoint. So typically, those are going to be high income earners that we can reposition rather than dumping a pile of money into, into a qualified account or anything like that. Is something that we could reposition over into something like this, reposition a portion of their income, and then we start to leverage it and then add to their portfolio having a tax-free option rather than a fully taxable. So I'd say that's going to be more, again, so your 30s to call it 50s. Early 50s is usually the conversation that we have from there. 50s into your mid 60s is going to be repositioning of assets is typically where we're going, whether they have money in the bank, whether it be, again, could be qualified money if we're over that 59.5. If they're willing to pay the taxes on that money, we could do a 10 pay to stretch that money out. Again, conversation there is you want to pay taxes now while they're at their lowest, reposition it, grow it tax free. It could be annuities, that non-qualified annuities that we could take the 10% free withdrawal off of and reposition it over into something like this and start to leverage it. So those are going to, again, the 50 plus is going to be more repositioning of assets rather than income.
So guys, I've got a question for you guys. If you ask your clients, are tax rates going to, everybody answers this with a Y or an N. If you ask your clients, do you think, or how about an up or down? If you ask your clients, which direction do you think taxes are going to go? What's 99% of your clients going to say? Everybody answer that. Okay, everybody's saying up. 100% of people are saying higher. Okay, and so here's a second question. Do you plan for your assets to go up or down in the future? What's everybody going to say to that, up or down? Okay, so if taxes are going up and their assets are going up, when would it be a good time to start putting a tax-free scenario into place? Would they rather pay higher taxes or lower taxes? They all want to pay lower taxes. So why would they, if they think taxes are going to go up and they think their assets are going to go up, and if their assets are going to go up, what's going to happen to the amount of taxes they pay? Well, their amount of taxes is going to go up because, first of all, they think taxes are going to go up. Second of all, when you have more money, you're going to pay more taxes. So when would be a good time for them to do this? It'd be done right now. So those are easy questions to ask people. Do you think taxes are going to go up or down? Well, they're all going to go up. Do you think your assets are going to go up or down? Well, they're going to go up. Okay, so if taxes go up and your assets go up, that means your taxes are going to go up doubly. So when should we be doing this? Should we be piling all of our money? Now, hey, put money into a tax-deferred account. Put money into qualified money accounts. But guess what we should also be doing in a well-hedged or a diversified portfolio? Should we be putting all of our money into tax-qualified accounts, guys, for our clients? Again, if that's all they have, we're not talking about somebody who's making $50,000 a year. We're talking about high-income earners. Should they be putting all their money into qualified accounts, or is this an awesome way to diversify and hedge their bets against taxes in the future? So if you work primarily with older folks, during your annual review, what's something you could actually ask people? Say you're working with somebody who's 60 or 70, what could you ask them? You should be asking them what? About their children. And if their children are in jobs that are high net worth, guess what you could be actually leveraging those annual reviews into? Appointments with their children to go over things like this. How many high net worth people do you think have seen what Andrew showed us here today, percentage-wise? More than 10% or less than 10%? Walt says 2%. I would agree with that. So this is a great, and first of all, anytime you have a concept that nobody's seen before, what does that do for you? When you have a concept that clients and prospects have not seen before, what does that do for you? That is a unique selling proposition. It gives you an opportunity to have conversations. So who in your community, if you're, who in your community could you go talk to this about? Obviously, any high net worth. So if you have if you live in a community that has a lot of tech, like Des Moines, Iowa, now has Google there, it has Facebook there, it has whatever. So there's a lot of now. Nashville, same thing. Does your city have a lot of high paid tech people in your city? How about doctors? How about business owners? So these are things that they've never seen before, and do you think they'd be interested in things like this? I think they would. So does that give you some ideas on to get the creative juices going on who you could approach with this kind of thing? And we have so do you have a strategy to pass on your assets as tax efficient as possible? Guys, how do these assets pass on? How do these assets pass on to their, do you pay tax free? So can we get any more tax efficient than tax free? Not that I'm aware of, unless all of a sudden the government's going to start paying us. So please, please, please put your thinking caps on. And a lot of these guys don't do a ton of life insurance. So these pay fair. Guys, life insurance pays much better than any other type of asset that you can show to people. So if you can benefit, if they can benefit, if their kids can benefit, is that a win-win-win? The only entity we're taking out of the equation here is the government, right? So please put your thinking caps on and think who this would work for. So anything else, Andrew?
No, I guess I was just gonna piggyback off that a little bit more. I know that from the standpoint of doing more life insurance, talk to Jerry, talk to Matt on, we do a lot of annuities that allow 10% free withdrawal of the initial deposit, right? F&G, Allianz, and Athene, I think, are the main ones. From the standpoint of passing on assets, if you run into individuals that don't need that qualified money for income in retirement, right, rather than waiting for RMDs or passing that on fully taxable, drop it into one of those annuities that allows for 10% of the initial deposit. So if they have $500,000, we can take $50,000 a year for 10 years, put it into a life insurance policy, whether it be in IUL that is accumulation focused. It could be a protection IUL that has some sort of chronic illness or LTC that we could help address that problem. And then again, that death benefit is being passed tax-free. So now, again, they are taking the distributions. We withhold the tax liability from that distribution, and we take the remaining and throw it into a policy that is going to either accumulate or pass tax-free, or if we have some sort of rider for LTC, we can have a tax-free LTC option as well. So again, just a few other selling points or client opportunities if you run into people with qualified money that, you know, maybe they're just waiting to take RMDs because they don't need the money. So we could reposition it, start to put it over into a tax-free account rather.
And then we have that's awesome, Andrew. And then we have a question about those who could not be joint contracts. Could they? They'd have to be individual, or could they be joint? Especially when you talk about the long-term care riders and things.
Yeah, so if we do the LTC, so yeah, if we're going to reposition, they're going to pay that, and we're going to fund it with after-tax distributions. We do have second-to-die options. From a death benefit standpoint, we could leverage that on a second-to-die. You're going to get more death benefit for legacy. Or we could look at, if it's an LTC play, you know, like a One America or a Nationwide. Nationwide has a second-to-die protection IUL that you can split the death benefit in half, and each will have their own LTC pool, and you're going to get a better leveraging because it is a second-to-die option. So we do have joint options on that life side.
Awesome. Yeah, I mean, I did not know that. So that answer your question, Tom? Yep.
Yes.
Cool. Anything else, guys? Any other questions while we have Andrew? But he's given you some great ideas. And again, these are things that people don't normally think about. Their advisors certainly are not talking to them about. And how would it be worthwhile at least walking through this with your younger clients during a having a can you put up those graphs again, Andrew? How many and you said mid 60s, right? Anything below mid 60s. So young young 60s, 50s guys. At your annual review, do you think people, not that they would do this, let's say none of your clients did this, but you showed this to them, what would they think about you? That you're creative, that you were thinking outside the box, that you were showing them things that nobody else had showed them, or are they going to be mad at you? Yeah, they're looking for what? People with good ideas. They can pop their money in any investment nowadays without your help. So they're looking for people who have ideas. And especially the higher net worth they are, guess how many ideas they want? Whether they do them or not, that's a moot point. The higher net worth they are, they want more or less ideas. They want more ideas. And this is and ideas they have not heard about before. Make sense? Any other questions for Andrew? Okay, Andrew, anything else?
Andrew, do you have your
Go ahead.
contact information for the individuals that would like to just reach out to you directly?
Yes. Let's see here. I can, how do we want to do? Do you want me to blast it out, send it over to you guys? It's just Andrew at ecamarketing.com.
Yeah, if you send it over to me, and
Okay.
I think I already have it, obviously, but I'll just post it along with the call, guys. So
Sure.
right where the replay is, I'll post it. Andrew will be listed there as our resource. So if you have questions that are, I know there was a few very specific ones that came up, so those would be great questions to just contact Andrew directly with, and he can answer those very specific ones.
Awesome. Thank you so much, Andy. This is great information I was not aware of. I'm sure most of the guys were not aware of. So thank you very much for taking the time to do that.
Absolutely. Thanks for having me on.
Yep. Thanks, guys.
And then we'll commence with try number 2 with our script workshops. We're going to be talking about the intro script to the 21-point checklist here in 5 minutes for those of you that want to be on that call. Thanks, everybody. Have a great rest of the week. We'll talk to you next Monday. Thanks, Andrew.
Thank you.